In 2006, Donald Trump hit a writer with a staggering $5 billion lawsuit for claiming that he was just a millionaire and not a billionaire. That is crazy. Welcome, everyone. My name is Daniel Huber, and this is the Golden Parallel, where we discuss the stories, trends, and financial insights shaping our world. Join us every Monday, Wednesday, and Fridays. We explore news and markets across North America, Europe, and Asia. In today's episode, we'll delve into the current overvaluation of the U.S. stock market and explore its future trajectory, as well as where value could still be found in the next few years. But first, we're going to go ahead and move over into our weekly headlines. The S&P 500 and Russell 2000 rose 1.68 and 4.34% respectively in the past week, continuing to follow a strong surge this year of over 30% each. So that's great. If you are an investor in those type of index funds, you're doing quite well this year. Bitcoin hit an all-time high of $96,000, getting closer to that $100,000 mark. Over the past year, Bitcoin has risen 156%, which really came in from the election of Donald Trump. So a lot of that value was really here in November is when that happened. Mexico is actively modifying its trade policies to reduce reliance on Chinese imports, aiming to maintain its position with the U.S.-Mexico-Canada Trading Agreement, or USMCA. President Claudia Sheinbaum has initiated efforts to replace Chinese components with domestically produced ones, addressing concerns about potential exclusion from that trade pact. So Mexico's getting a little scared here. They are pushing themselves away from China and trying to align more with the North American countries right around them. Makes sense to me. I would probably do the same. Macy's has delayed their Q3 earnings reports after discovering an employee hid over $150 million in delivery expenses. The company recognized about $4.36 billion of delivery expenses during that same period, so it's not a huge amount if you compare it to what they incurred, but it's funny that a single employee was able to hide over $150 million of those expenses. I mean, that boardroom has got to be pissed off. President-elect Donald Trump's commitment to mass deportations of undocumented immigrants has raised significant concerns within Texas's construction industry. Industry leaders warn that such actions could severely disrupt housing and infrastructure projects in one of the nation's fastest growing states. So with that, we're going to go ahead and take a quick break. Stick with us to hear a conversation on the state of the U.S. stock market and what areas you could look to find a good deal. Welcome back. Our conversation today will be on the current state of the U.S. stock market and what opportunities still remain for finding value over these next few years. As of 2024, the U.S. stock market, encompassing the New York Stock Exchange, the NASDAQ, and other exchanges, remains the largest and most influential market globally, with a combined market capitalization exceeding $60 trillion. So there's a lot of money in the U.S. stock market. Now, why is it overvalued? Why are people saying that maybe this is not the best time to dump a ton of money in, even though we have a president coming in who is quite inflationary and likes seeing asset values go up? Why should you be a little hesitant? Sorry. Well, there's a few numbers I'd like to point out real quick. So one of the easiest ways to look at a stock market's valuation is to simply compare it to the country's GDP. So that is called the Buffett indicator. It was made famous by Warren Buffett. He uses it a lot to see if the market is worth investing in or if it's overvalued and worth kind of sticking away for a little bit. So if you compare the US GDP to the stock market valuation, you get 61 trillion, that's the stock market valuation, to 29 trillion, which is our GDP. It's about a 208% difference between the two. So that indicates that it's actually 2 standard deviations above what it should be. Now, another way of looking at things is price to earnings ratio. So the current S&P 500 10-year PE ratio is 36.5. That is 79% above the modern era market average of 20.4, putting also the PE ratio 2 standard deviations above what it should be. So if you look at some of the basic numbers here, it does seem like the US stock market is quite overvalued. And that makes it dangerous, right? It's the idea, right? You buy at the top. Why would you want to buy at the top? You want to buy at the bottom. So if you're looking at investing and you're not going for the 40-year term, right? Just investing and holding it over the long run, you should be a little careful right now. Definitely be a little careful. Now, if you're buying index funds like the Russell 2000 and the S&P like a VU, right? And you're going to hold it for 30 or 40 years, this doesn't matter. Just keep buying because your price to cost, your cost ratios will average out over the long run because you'll buy when it's high and you also buy when it's undervalued, right? And so it'll even out. So if that's the case for you, don't worry. Just keep going the way you're going. And I do a lot of that as well. That's a majority of my investments. I've really only 10, 20% that I play around with because I don't want to incur that much risk. Another important factor to look at right now is actually the US Treasury yield curve, which is currently inverted, meaning that short-term interest rates are higher than long-term interest rates on bonds. So the 1-year bond has a higher return on it than the 10-year bond. This is quite an unusual occurrence over the history of the stock market. And historically, it's been actually a very reliable indicator of an upcoming economic recession. And it really is indicating that in the short term, investors and the market in general is quite wary of continued growth, right? Because the risk is higher. That's why the interest rate's higher. If you also look at famous investors, a lot of them are signaling pullbacks in their view of the market. So Berkshire Hathaway actually has over $300 billion. That's an insane amount of money in cash reserves right now. And Warren Buffett actually is continuing to sell stocks, especially high end tech companies like Apple. He continues to sell. Now, he still has a large position with a lot of these companies, but he's selling quite a few shares, indicating that he does not believe that these companies are going to continue to rise at a really solid rate. Michael Burry as well, another famous American investor, took a lot of his money out of volatile sectors and industries and reinvested them into either sectors across seas. For one, he invested a lot of money into the Chinese tech market, which I'm going to talk about here in a little bit. And he also invested into stable or low beta industries. So think of like companies like Walmart, Target, companies that when you go into a recession, they don't really see a giant hit in their stock valuations because people still need to buy groceries. They still need to buy clothes. And these are the stores they go to, whether it's a recession or whether we're in an economic boom. Now, what does the stock market have going for it, right? What does it actually, what are the signs we're actually on a great pace here? Well, a lot of Trump's policies should actually help out stock market prices and be inflationary. One thing is that he wants to cut corporate tax rates, right? That should pad the coffers of the balance sheets of these corporations and should help their stock valuations. He also is really just like a beacon of the stock market. For some reason, when he says something, people just love it. If you look at the fear index right now, which is VIX, that's the ticker symbol, it's actually quite low, even though we are in a time where it kind of feels like it should be much higher. So the VIX is currently trading at about $16.50, and that's 14% below its historical average of 19.5. And that suggests that the market sentiment is seeing something quite positive, which is interesting because a lot of statistics are going against that. Now, it's really hard to say and tell the future, right? Economists, have predicted 100 of the past 10 recessions, right? Every single year, there's always some guy or some girl screaming recession, recession, recession. So really do your own research, look into this yourself, try and figure out how to manage your risk and offload some into bonds. If you're investing very heavily into the S&P 500, that should give you some leeway. Even if the stock market does go down, those bond values go up. you flatten back out. Now, where could we find value in the US stock market or in other markets around the world? The first place that I want to talk about here is actually the healthcare industry. So I have a degree in technology. I'm getting in my second degree in technology right now. I got a semester left, and it gives me an edge. And what I mean by that is I know how machine learning and AI works. I know how to build databases. I know how web apps and web applications like websites work. And that edge is really helps me look at the technology industry and where that can apply in other industries and things that are will be in the future very, very valuable. Now, one area is in healthcare where machine learning AI could really take a lot of value. So the way to think about this is that the healthcare industry is massive. I mean, it is gargantuan in terms of how much money gets poured into there, right? Think of Medicare, think of Medicaid. Think of, and that's only the governmental side that puts like almost a trillion, or maybe it's even more than $1 trillion into the healthcare industry every year, right? That doesn't even count the private investment that gets put in there. So there is a ton of money in the healthcare industry, and it is ripe for innovation with machine learning and AI. So I am looking right now, and I think you should as well, at companies that are in the technology sector, but they're trying to build solutions for healthcare. You know, machine learning models to diagnose disease or to try and give a treatment, right? Or look at echocardiograms and see if is there cancer here, right? Those type of machine learning models could offer a ton of value to companies, and companies that can make those products and services and sell them will make a lot of money. And so I think there's some major players that could come out and do stuff like that. So I'm looking for tech companies that are developing those solutions in the healthcare industry because I think that's a very, very strong place for value. And I recommend you do the same. Now there are other industries where machine learning will really help out, but I think healthcare is the one that is the most valuable, right? Because of how much money is simply poured into it every year. Now, as I said before, Michael Burry is investing in Chinese tech companies, and he's not actually the only American investor that's famous that is doing that. Actually, there's more than one, and I think it's a good idea. It's a good plan. It's a good bet. If you look at China right now, they're going through a housing market crisis. So a lot of the stocks of their largest companies, including their tech companies, are quite undervalued. I have them pulled up right here. Baidu, which is I think the biggest tech company in China, it's up 2.5% today. But if you go to year to date, it's down 31%. And China kind of has two pathways forward here. Either they could resemble the United States after our housing market crisis in 2008, where we just boomed up after that, or they could resemble more of Japan in the 90s, where they come out of that housing market crisis and they kind of flatline for 10 years. Now, I am more of the opinion that it will be the first one and not the latter, as the difference between Japan and China is that China has much more natural resources, much more land, and much more people. If you look at China's economy and you compare it to how many people they have, it actually is really undervalued. You know, they have a lot more value they can squeeze out of their economy. And to be entirely honest, they actually could have easily the largest economy in the world, far surpassing the United States. They just do not have the development necessary to get there yet, but they are moving towards that. They're doing a lot of initiatives to build high end manufacturing plants and technological innovation areas in their country. And they're starting to catch up to the United States. So I think and I would bet that they actually will come out of that far better than Japan did in the 90s and more resemble the United States after 2008. So I think a lot of technology companies in China very undervalued and definitely worth taking a look at to hedge your bet against the United States going into a recession or stock values in the United States kind of flatlining for 10 years, which is it's not improbable. It's not improbable at all. Now, I would like to see what you guys have to think about this. There's not much to say beyond what I've already said. It's kind of just a waiting game now. We could talk a little bit about Trump's policies. They are kind of hit or miss in terms of whether or not they would help out the US stock market. His deportation of illegal immigrants would definitely take a hit to our economy. It would raise unemployment, which would squeeze inflation. Tariffs as well would hurt the United States economy in the short term, and not pad the balance sheets of companies, but actually hurt the balance sheets of companies. And they're going to have to either one push those costs off tariffs down to the consumer, or just take a hit to their line budget. And it's hard to see which one they do, but either one, it's going to hurt them. The third thing here is that Donald Trump also wants to cut government spending. And that is also an issue because that's a huge driver of the United States stock market and economy. If you cut off, let's say, $500 billion, which I'm not entirely sure that's all under the the executive branch, because obviously Congress is the one who makes the budget, but there is some money that's just dedicated to the executive branch that Trump can cut. If you can cut $500 billion, I mean, that's just $500 billion that's not in our economy, right? That's $500 billion that's not paying people salaries or contracts to companies, right? So it is literally reducing the United States economy. But we do have to pay our debt. We have a debt that's growing and we got to pay it, right? And so just like a debt when you get out of college, right? You have $50,000 of debt when you get out of college. You're going to have to put off some economic security and some economic prosperity to pay off that debt. It's no different with the United States. We're going to have to, at some point, push off that economic security and prosperity to pay off our debt. So it's probably better to do it now than later, you know? Another thing that Trump has going for him, the stock market has going for them, is that he wants to cut regulations. That should help kind of ease up the leeway in some companies, and maybe give them some more opportunities than they did before to make more profits or to reduce costs there. So it's a really big yin yang thing that's going on with the future of the US stock market. Currently, it is overvalued. It really should regress back. I would be very skeptical of putting a bunch of money in right now. You were literally buying at the top. In terms of like the future of the next few years, we're just going to have to see what Trump decides to do and what the Trump administration decides to go forward with. Are they going to deport a lot of immigrants? Are they going to put up a lot of tariffs? It's really hard to tell. And so when that becomes more clear, then it will be far more clear whether or not the stock market will continue to rise in valuations, to become even more overvalued, or kind of regress to the mean there. But yeah, that's it today. Thank you for watching. I appreciate it. Come back Wednesday, and we are going to be taking a look at Europe. And more specifically here, we're going to be taking a look at the political crises happening in Germany, as well as the escalation of the Ukraine-Russian war, with the US and UK allowing Ukraine to strike into Russia with their missiles. So thanks for watching, everyone. We'll see you Wednesday.